Good evening. This is David Priest with Paratus Commercial Group. I'm here with Momentum Multifamily, Dustin Miles and Hayden Harrington. We're going to talk about tonight the Income Fund 2, which is an opportunity with much higher cash flow than a typical investment in a multifamily deal, but is supported by a specific multifamily property that we're going to talk about tonight. So give me just a moment to share my screen and get started. I'm going to go through this, and then I'm going to let Dustin and Hayden handle the Q&A. So give me just a moment. I'm going to share my screen. All right. Thank you for your patience. So this is the Momentum Multifamily Income Fund 2. This is an A- property that's going to be backing up this tranche of this fund. It's 257 units built in 2013. This is in Northeast Houston. For those of you that are familiar with Houston, it's over in the Summerwood area, I think would be the closest area. It's more South Humble or Summerwood. So this is the property that we're going to be talking about that's going to be backing this investment. A little bit of housekeeping, going over a disclaimer. The business plan contains privileged and confidential information, and unauthorized use of this information in any manner is strictly prohibited. I will do a recording, so I'll be sharing this with other people, but don't share that without permission. The SEC has not passed or looked at the merits of this approval or securities, or in terms of this offering, they have not reviewed it. Investors and other people looking at this need to understand that these are forward-looking statements. They're predictions based on current information, assumptions, and expectations, and that all investments have risk. Business plan contains future financial projections and forecasts. They're based on numerous assumptions and the experience of this team. They're hypothetical scenarios, and the sponsors explicitly make no representation or warranty of any kind in respect to a financial protection or return on the investment. The business plan also contains performance data that represents past performances. Past performance does not guarantee future results. Current performance may be lower or higher than the performance data presented. Okay, let's move on. So let's talk a little bit about the team here. And first of all, Dustin, he's a managing partner of Momentum Multifamily. He syndicated 14 multifamily deals, totaling more than $233 million in transactions across 2 different states. And he's also raised over $74 million in equity. He's seen 7 transactions that have gone full cycle, and is a seasoned multifamily syndicator and asset manager. He's got a passion for helping others and making an impact in the life of investors, tenants, and employees. And the main thing I look for in investments like this is Dustin's been full-time in multifamily for more than 10 years. So he's gone down the river in the currents and gotten through that and come out on the other side with a lot of experience. Hayden is a resident very near in Conroe, very near the property and also near me. He's one of the managing partners also at Momentum Multifamily. It's a commercial real estate group focused on buying institutional quality assets for their investors. Together with his business partner, Dustin, they have $138 million currently under management, and they've raised over $49 million in equity. Hayden has a passion for building teams and creating inspiring places for tenants to live while providing exceptional returns for investors. And last and probably least, me, I've been a full-time real estate professional for over 20 years. I'm currently a general partner in about 1,200 apartment units. I got into multifamily about 3 years ago and really did a really deep dive into it, both as a limited partner, investor, and as a general partner. And my specialty is educating people to avoid risk and understand their investments. And I'm a native Houstonian. I live about 30 minutes from this property. So I've got a real good idea of the area and the property. I've driven it, and it's amazing property. So let's talk about their track record. This is Hayden and Dustin's track record. Their team has acquired over $350 million in assets since 2014, and they're buying and operating through a global pandemic and a recession. My people don't remember that was a recession during the pandemic. And they've owned and operated over 3,000 units across Texas and Oklahoma. They currently have 886 units in Houston alone. And the team has gone full cycle on 9 deals with an average equity multiple of over 2x with an average hold period of 3.2 years. So just to make that really simple, they're really good at doubling your money every 3 years. That's what they've done in the past. That's a track record. They look for B to A multi-class, multifamily assets, and really focusing really more on the A and A minus. And this property is definitely an A or an A minus property. So these properties seem to be doing better in the current environment as far as occupancy, and are a lot easier to manage than your value add or your C-class assets. They're based in Texas and buying in Texas. Houston and DFW are primary investment targets. And acquisition strategy enables us to visit the sites weekly. And I would say like Hayden is all over it every day, everywhere. He's like all over these properties. And one of the coolest things was we did a bus tour of one of the other properties on Friday. It wasn't this property, but just to see that all the thought that goes behind creating a welcoming environment for people when they come in the office or they come in the property. And I was really amazed by that, because there's a lot of stuff they put into these properties that a guy like me wouldn't even think about in the first place. So they did an amazing job. So scaling smart, this shows their assets around Houston. It's really in the suburban ring. They are focused on properties that are more in the suburbs, low crime, properties that are easier to manage, A-class assets, stuff that's 150 units and up. So they're institutional grade assets, and they're easy to find buyers for when we want to sell, because they're primo assets, regardless of what the market is. This offering is a 506C, so it is for accredited investors only. And we're going to accept cash, obviously, IRAs, solo 401ks, EQ, RP, or a combination. So you can use an IRA for part of it and cash for part of it if you had some leftover IRA or you want to use it in that way. The minimum investment offering is $50,000. So that is the minimum. And it's on a first come, first served basis. We're raising for a tranche that's going to be associated with the property we're getting ready to go over right now. So this is not, in this part, a blind fund. We're putting money in an actual property. We're going to show you the property and what we're going to do with it. So the property is in Humble, Texas. It's called the Henry at Woodland Hills. You can Google that in your phone if you want to see some other pictures of it. It is a stable cash flowing property right now. It's a well-maintained 2013 build, so it's a newer property, 257 units, class A minus multifamily property, and is conveniently located on the northeast side of Beltway 8, which quickly connects it to all the major areas in Houston. The property is bordered by Generation Park. It's a large business development that spans 4,200 acres. And there's also a lot of retail in the area, H-E-B, Walgreens, CVS, and more. And there's some value add opportunities on this property that they can do too. Like I said, once again, 257 units, 2013 build. The occupancy right now is 90%. And you can update us. It may be even higher now. It's on 11.45 acres. The in-place rents are $1.1, and 47 cents. And then in-place rent per unit is $13.53. Okay, great amenities. This is a high-end, high-class apartment complex. It's got a 24-hour state-of-the-art fitness center, a swimming pool with a sun deck, picnic areas, kids' playgrounds, Wi-Fi at the pool in the clubhouse, remote-controlled access to get in and out of the property, a business center, complimentary Wi-Fi and a coffee bar. They plan resident functions, obviously, to make it more of a community. There is available garage parking or covered parking if residents need that. And there's also storage lockers for Amazon parcel deliveries, which is huge. Now, the population growth in this submarket and area was 306% from 2010 to 2022. So this part of East Houston, South Humble, and Summerwood was exploding. It's one of the few places in Houston that really wasn't built out, and you're seeing a tremendous amount of growth there. The average household income in 2022 was $150,000, so it's an affluent area. And you can see in 2026, it's $173,000. So you have high incomes in the area, and it is expanding income. And the income went up 15%, basically. Most of the jobs in the area are white-collar jobs. This is not really what you consider workforce housing. It's more of an A-minus property, mainly white-collar workers. And home values in the area are about $850,000. So it's a high-end area. really adjacent to Summerwood and South Humble, which is a high-end area as far as residential homes. The valuation currently for this property is $57 million, and that represents a conservative 65% LTV with the mortgage, the senior debt, and with the preferred equity added together. And I'm going to show you on a chart how this works. It'll make it a little simpler to understand. This valuation represents a sale price of $211,000 a unit, aligns with many of the sales comps in that submarket. So the debt financing on this is going to be $35,619,400. That's a total loan to value of 65%. Interest rate 5.35%. This is going to be a 35-year loan because it's a HUD loan, and that is a fixed rate. So we're not going with anything that's going to be floating or anything like that. This is going to be fixed rate debt on this senior loan. Okay, here's where the important part is the safety of the stacking on this. So I just talked about the senior financing, which is the $35.6 million. The investment that we're looking for tonight is $2 million that's going to be stacked right above that. So after the loan is paid off, the people doing this investment are going to be first in line to be paid. So this is preferred equity. We have 3 different classes of preferred equity we're going to do on this. If you're going to do $250,000 or up, we're going to do an 11% return, which is going to start in March. We're also going to put 6% accrued interest on the back end for a total annualized return of 17%. If you want to do a Class B $150,000 investment, we'll do 10% on the front end on that return, which would start paying cash flow in March. The accrued interest is still 6%, total annualized return 16%. And this is for a 3 to 5 year hold. So it could be as short as 3 years. And then the Class C, if you want to do $50,000 minimum, that would be a 9% return on the front end, paid monthly, starting in March, accrued interest of 6%, and then a total annualized return of 15%. So the way to look at this provides a lot of cash flow immediately. If you're looking for cash flow, if that's what your need is, we're going to have that. There's a 6% upside on the exit, and you're going to be paid the cash flow first and the exit first before any of the other limited partners on this deal, or obviously the general partners. Everybody, all those people are always at the very end of the line. Okay, so the investment has cash flow right now, day one. So the current net operating income, and this is annually, is $2.7 million. The senior loan and the preferred equity for the fund is $2.4 million. So after the senior loan is paid, after the preferred equity that we're raising is paid at the percentages that we've already stated, there's still $300,000 left over in cash flow. And that's right at this moment, not including increasing cash flow, raising rents or anything like that. So this is an investment that is going to start cash flowing immediately, and there is margin. And as soon as the mortgage is paid, the distributions are going to flow to people that are involved in this investment right away. So went through this a little bit on the sheet before, but let's look at it a little bit differently as far as the investment. So let's say you do $250,000. The 11% is going to pay you basically $27,500 per year is the way to look at that. And then if you look at that each year, and this goes out 5 years, okay, then you would be paid $27,500 per year. And then you would get a 6% return at the disposition. So there'd be an extra $75,000. So the total investor return would be the $352,500 is what you would get out of the deal over the 5 years. So you obviously a very high return on this of 11%, but you're also getting the upside too. And if you look at this, the exit cap rate, as far as the sensitivity in this bottom column, it's not very sensitive because you're stacked on the very bottom of this. So if we have a higher exit cap rate than we think we will, or a lower exit cap rate, it's really not going to make a difference. Just to be clear, you are going to be capped out at your investment amount plus the 6%. So you have upside, but the upside is limited. And then after that, money flows to the other investors. Hope I'm explaining in a way that's totally clear. Okay, so the Class B $150,000 minimum, this is going to look very similar. $115,000 investment, you're going to get 10%, very simple, $15,000 per year, and then it would be $45,000 on an exit. So you would take the 150,000 and it would go to 210,000 over the 5 years. Now, obviously, we could exit early, and there's a good chance we will, but we want to show this as a very conservative 5-year business plan. Same thing on this as far as the sensitivities on the cap rate. Even if the cap rates go up significantly, you're going to get paid the same amount of money either way. So this is not a deal that's very sensitive to cap rate because of the way you're stacked on the pref equity and stacked lower, but in front of everybody else. Same thing on $50,000 minimum. Let's say you do $50,000 year 1 through year 5, you'll receive $4,500 per year, and then $15,000 on the exit. So that $50,000 would turn into a total of $69,500. So it's 9% preferred return, and then the upside on the 6% also. And that tiers for people that are doing $50,000 plus. Once again, same thing on this. This is not sensitive to the cap rate. So if the cap rate is low, 4.5%, wow, that's fantastic. The property's gonna be worth a lot of money. It's not going to make a difference in what you get paid. If cap rates are higher for some reason, like interest rates go up again, something like that happens, this is not very sensitive. So it's a very, very stable deal, and it's very stable and not subject to the market as much as a regular equity investment would be. Okay, so fee disclosure is very simple. There's really no fees on this. So there's no asset management fee, there's no acquisition fee, there's no refinance fee, there's no disposition fee. It's really the amount you want to invest. Do you want 9, 10, or 11% paid on your annual, and then a 6% upside? So you get a 15, 16, or 17%, depending on what type of investment as far as the numbers work for you. So next step of the investment process, review this investment. I'm going to put in the comments a link to the deal room. You're going to go in there and commit. This is just like any other investment that we've done. You've got to sign a subscription agreement, a private placement memorandum, the operating agreement in question, everything will be in there. And then the team will review your submission and reach out to you, and then you can fund your investment. And then everything is basically done. So the distributions on this, once again, start March 15th. And it's something I'm really, really, really excited about. So let me do this. Let me stop my share here real quick. And I'm going to go to Q&A and see what questions we have. And then I'm going to let Dustin and Hayden answer these questions. And I'll put in the chat, if I can, what the link to that deal room is. So give me one moment here on Q&A and see what we got. No open questions right now. So I'm waiting for people. Please ask questions. Okay, here we go. We got a question coming in. Okay, how much of you as partners are investing in the fund? Okay, that's a great question. So I'm going to answer myself personally. I will do at least $50,000, probably $100,000 in this investment. I just looked at this very recently, but I will be investing in it $50,000 to $100,000. Hayden or Dustin, do you want to unmic yourself or unmute yourself?
Oh, Dustin, we can't hear you for some reason.
Here, let me.
Oh, that worked.
Okay, does this work?
Mm-hmm.
Okay, perfect. Yeah, I'll be investing at least 50,000 on my end too. I might do a little bit more. So.
Okay.
Yeah, and then I'll probably do the same as well. And then we've actually invested in this, since this is Fund 2. We also invested in our Fund 1. And we've got a little over a year of experience with that as well.
Mm-hmm.
Same concept, investing in the same type of deal. Actually just, not too far from this deal, actually probably about 10, 15 minutes down the road. And it's paid out and been really great cash flow. So we've been, excited about it.
Yeah.
Okay. On the capital, there's a question here on Can we go into more detail on how the capital will be used? So let's go into some detail on that. I think we're on this one, we're doing a tax abatement. And can you go into all that, or what has happened so far and what the additional money is going to be used for?
Yeah, I'll touch on that, and yeah, if Hayden wants to add anything else. But so there's a so for instance, we're in the process of rate locking this deal to set our rate. We're probably going to be 5.25, 5.3, so actually lower than what was listed on the chart or the PowerPoint, which is great. So we have a gap between our loan amount and the amount that's needed. So in this case, there's a gap. So part of the money is going to be used for that. We also have some accounts payable, and then because we've already had the tax abatement locked in. We got the tax abatement locked in last April, in which they're not cheap. So there's a lot of costs that were incurred there. So a lot of our savings was honestly kind of dried up from that, and so it's to kind of build up reserves, just basically to put the asset in a good spot, moving forward.
Yeah, by doing the tax abatement, that's going to increase the NOI, obviously, and then we're locking this into fixed term debt, and we have more NOI than the debt payment and the pref equity that we're raising.
Mm-hmm.
And then there's another question about why is there no? It says where, but I think they meant to say why. Why are there no asset management fees?
Yeah, I'll tackle that one. So part of our goal here, like Dustin and David touched on, we're in the process of refinancing this deal. So it's really to just situate it, and like we said, we just spent a ton of work locking in the tax abatement, so that wiped out the tax liability and then increases the NOI significantly. So that also drives the property value and so forth. But we're still coming out of a bridge loan. So we did a loan modification with our existing lender to lock in that tax abatement. We're looking back in hindsight, we're really thankful that we did because it's with the Houston Housing Authority here in Houston. And shortly after we had done that, they actually stopped accepting new deals. And so we got it approved. We talked with the board and a lot of the attorneys from HHA constantly. And so we're really thankful for the partnership. This is one of 4 that we have with them as well. So our intent is to situate the deal and put it in a good spot, and to just refinance it into a fixed rate loan. So we're not looking to make fees on this. That's not the intent of the fund. It's for a win-win for investors to get cash flow from a unique opportunity because there's not a lot of deals out there that have taxes fully abated. So that's a great way to significantly increase your NOI at the property, and there's a clear path to be able to pay that preferred return. So we feel it's a unique combination for investors too, where it's helping the deal get it into a fixed rate loan, but it's also solving the cash flow problem for investors as well, for those that are looking for that, because we've been able to significantly increase the NOI here. Oh, David, I think you.
Thanks. We're taking an asset that they already own, and they're restructuring this. This is something that was bought back in the heyday, and they had bridge debt on it. They're getting out of the bridge debt. We're putting a HUD loan on it. This is going to be fixed rate debt, and then getting the tax abatement. It's going to make the property cash flow a lot better, and it's an institutional grade asset. And the people investing this are going to be stacked where you're really at a 65% LTV. So you're right at the bottom of that stack, being paid first off the cash flow, which is sufficient right now to pay these distributions right out of the get-go. And then also in a place that's safer, and it's to make the deal stronger and make the property stronger.
Mm-hmm. Yeah, and we took to just piggyback off that, we took the in-place NOI, so not pro forma either. I see another question from Chris. How long have we owned this property? Since I think it was August of 2023. So just under 3 years now. It's been a good deal. It's, right there in the path of progress. It sits on the north side of Generation Park, which is probably 10 minutes away from where Eli Lilly just announced the new $6.5 billion facility that they're putting in there. So we're super excited about that. And then literally across the street on Woodland Hills there's a development called The Bend. You can look it up online. It's called The Bend in Houston. It's right there at the Beltway where it bends southbound. But it's literally across the street from us, and it's this massive mixed-use development that's already coming in. They've already developed the apartments, I think probably about when we bought it, about a couple of years ago. So that's already done, and they're preparing for the mixed-use retail out front. So we're really, really excited about that, and the changes that that's going to bring for this area. And then on top of that, if you just go north on Woodland Hills there too, it sits on the south side of the Groves, which is a fantastic neighborhood. So David touched on a little bit of the Summerwood area. Summerwood is right as the Beltway turns south there, but the Groves is super nice too. You got HEB right down the street. You've got a lot of new schools, and it's pretty darn nice over there.
Okay, another question on DSCR. Maybe it says previous or maybe the current. To get approved on a HUD loan, you have to be cash flowing. Can you speak to that, Dustin or Hayden?
Yeah, if you just take so our loan is going to be about 36.5 million, give or take, and about a 5.25% interest rate. That's just under a $2 million payment there. I think add on a tiny bit for principal, but with in-place NOI at 2.7, all you have to do is take 2.7 divided by 2. That's a debt service coverage ratio of 1.35. The treasuries we actually just wired the funds for that rate lock. So we sent the rate lock deposit in. As treasuries move around a little bit, that might change a tiny bit, but all indications are that we should come in under the interest rate that we underwrote, like Dustin said, probably by 5-10 bips, which will help with cash flow too. So the process with HUD, we've to touch on that a little bit too. We've been working with them, gosh, probably almost 9 months now, probably since we started the process. So it's been a lot of work to get to where we are now. We do have a closing date tentatively for February 5th. So like David touched on, we're excited to get this thing closed, cross the finish line, and then that next month start paying out distributions there.
I did just a few things, just to kind of touch on too. It's just about the property in general. So we're about to renew insurance and all that. Insurance is actually coming in quite a bit. It should come down 20+% is what we're being told. So we'll see what that final number looks like. So obviously that's pretty significant, big property and all that. So, that'll only increase our cash flow too. But we're excited. It's nice asset, brand new HEB, right down the street as well. It's pretty major thoroughfare. So they're putting in a light in front of the property, so people will, at the stoplight, they'll get to turn and look at the asset. So we're excited about that. And like Hayden mentioned, that the Bend, that development, they're wanting that to be a major destination as far as shopping for that part of Houston. So I'm really excited to be across the street from that.
Yeah, for any of you investors that are here in Houston or Houston area, if y'all want to go drive it or have me meet you over there, I'll be happy to meet you and we can walk around the property. We need to let the property manager know what we're doing, and we can actually walk on the property and you guys can look at it. This is like an amazing property. One other question is, how will this fund impact the current common equity investors? So stated differently, the original investors. I would think this would help them because the tax abatement is going to increase the value so much more than what you originally anticipated. Can y'all speak to that?
Yeah, I'll just touch on that super quick, then hand it off to Hayden. But if he has anything else, but yeah, so with the tax abatement that we have in place, originally purchased the property for 40 million. I think it was appraised without the tax abatement for 44. And then with the tax abatement, it was at 56 million. So it went from 44 million to 56 million. So that's, you take away your taxes and your NOI jumps up pretty significantly. And so, to have this tax abatement in place, big thing for current investors. And then the other thing is to get out of, from a bridge loan into fixed rate debt. So just, a lot more stability there, for current investors. But like, we mentioned during the presentation, the preferred equity investors for this fund would be paid, prior, before the LP investors.
Yeah, you're really in the same safety zone as the lender, basically. I mean, you're still at 65%, and right now you can get 65% loans all day long on regular agency loans. So you're down there in front of everybody. So you're going to be first in line right up to the lender to be paid when this sells. All right, let me see if we have any other questions. I think we've gone through all the questions. I'm going to give people a few moments. If they have any other questions, please put them on there. And if not, we'll end our call and give people a moment or two. I want to say special thanks for Dustin and Hayden for being here tonight. And thanks for everyone's patience with me. I got a little bit of a January cough I'm dealing with. So it's like the nightmare to do a presentation when you've got a cough, but I was able to get through it pretty well. And so thank everyone for being here. I'm going to follow up with everyone that was on this call tomorrow, and we will send out a recording. So I don't see any other questions. So thank you, Dustin and Hayden. And I will be in touch. And if anyone wants to set up a property tour of this property and they want to check out the actual asset, give me a call and I can set that up and we can make that happen, because I only live about 30 minutes from the property and it's a beautiful property and we'd be proud to show it to you. Okay, well, thanks everyone for being here and taking time out. Thanks again, Dustin, Hayden, and everyone have a wonderful night. And I'll talk to everyone very, very soon. Good evening.
Thanks. Yeah.
Take care.
Take
Bye-bye.
care. See you guys. Bye.